Hello and welcome to the October 2020 update call for Brompton's financial sector funds. My name is Mike Clare, Vice President and Portfolio Manager at Brompton Funds. And today I will be providing an update on North American financials and going over some of the top reasons why we think the sector presents an attractive value proposition at this time. So to get started, I just wanted to give you a quick overview of Brompton's funds that do focus on financials. So we've got one exchange traded fund, the Brompton North American Financials Dividend ETF, which is a fund that focuses on large cap, diversified exposure in the North American financial space. But this is important to note, it's not just banks and life cos. There are also some secular growth plays in here as well. We do find attractive opportunities in, for example, the payments and fintech space, companies like MasterCard, for example, as well as some other names like in the financial exchanges and data provider space that are going through a secular growth trend, such as S&P Global, for example. There are two units of the fund, BFIN, which is the hedged to Canadian dollar unit, as well as BFIN.U, the US dollar unit. We also have three split share funds that focus on financials. Brompton Split Bank Corp, which focuses on the 6 banks in Canada. Lifeco Split, which is the big 4 Canadian life cos. And Life and Bank Split, which is a combination of those 10 companies. And split share funds are a unique way to invest in Canadian financials. The Class A shares, of course, provide investors with an attractive distribution and excess returns aided by structural leverage in our call writing program. And the preferred shares provide investors with stable income and downside protection. So moving on to slide 3, in this presentation, we're going to outline some of the main reasons we think North American financials are an attractive buying opportunity now. Now, of course, financials in 2020 have come under pressure for a couple of main reasons. Number one, there have been many concerns with the pandemic-induced recession that we would see a massive increase in credit losses for the banks, for example. We've also seen worries that zero interest rate policies would lower net interest margins and reduce the profitability of the sector as well. At the same time, we think the 2008 global financial crisis is still fresh in everyone's minds. But this time really is different. The difference with the 2008 crisis is it was a crisis that originated in the financial sector. Banks had spent many years increasing leverage to buy risky assets. And eventually that spiraled out of control and banks were stuck with billions of dollars of bad loans. This turned into a solvency issue where many financial institutions went bankrupt, such as Lehman Brothers, or were acquired for pennies on the dollar, such as Bear Stearns. In 2020, we have a pandemic-induced sudden stop in economic activity. And so this has become a liquidity crisis where businesses and consumers may be temporarily unable to make payments on their loans. But we think that this liquidity crisis will not turn into a solvency crisis like we saw in 2008. And that's because there are several differences between 2020 and 2008 that drive our positive outlook on the sector. Number one, banks are much better capitalized now than they were back in 2008. Banks also remain profitable given the recession we're going through and are in a significantly better position to withstand an increase in credit losses. And I'll show you some data on that. The life insurance sector is also much better positioned today with improved earnings quality, driving persistently better returns for the sector. We've also seen pretty swift action from governments and central banks in response to the pandemic. And this has been on an unprecedented scale, and it ultimately serves to protect banks and other financials. At the same time, the sector remains cheap with valuations near record lows. And lastly, data shows that the fall has historically been the best seasonal period to buy financials. So let's look into each of these topics a little bit deeper, starting with capital levels in the banking sector on slide 4. The charts on this page show capital levels for the 8 US global systemically important banks, as well as the big 6 banks here in Canada. So a couple things stick out looking at capital levels. Firstly, capital levels today are significantly higher than they were back in 2008. And this is because a number of regulatory changes have forced the banks to raise capital levels over the past decade or so. The other thing that sticks out is capital levels continue to remain strong in spite of the significant uptick we've seen in a provision for credit losses over the past couple of quarters. For the US banks, capital levels have actually increased from the beginning of the year through the second quarter. And for the Canadian banks, capital levels are about flat to the beginning of the year, looking at the fiscal third quarter. So we've seen actually one of the biggest recessions that we've seen in a long time that's come along with a significant increase in the provision for credit losses, yet bank capital still continues to remain strong. So why is this the case? Looking on slide 5, we show a measure of bank profitability that has vastly improved over the past decade. So here we're looking at profitability prior to the impact of the credit cycle. So here we're looking at pre-provision, pre-tax profit margins, which shows how profitable a bank's base business is before layering on the impact of credit provisions. And you can see on the slide, on the two charts on the slide, that the profit margins for banks in both Canada and the US have improved quite substantially over the past decade. This puts banks in a much better position to withstand higher credit losses when the cycle turns, as it has over the past couple of quarters. So you can see that the 35 to 40% pre-provision profit margin that we see today is obviously much better than the 15 to 25% margins we saw back in 2008. And that puts banks in a better position to keep capital levels high and remain profitable even when we see a downturn in the cycle. On slide 6, let's move on to talk about the life insurance sector. So one common misconception about the life cos is that they are extremely sensitive to interest rates. And the reason that's misconception is historically that was actually the case. So obviously with most life insurance products, you're creating a very long duration liability. So think about a typical 40-year-old buying a life insurance policy, and that 40-year-old is expected to live for several decades still. At the same time, a life co's invested assets typically have a much shorter duration profile. And this mismatch creates a scenario where the sector is hurt by declining rates and vice versa. But over the past decade, we've seen the life insurance sector take significant steps to reduce this mismatch. That's through things like a shift in business mix to focus on products with less rate sensitivity. We've also seen a repricing of certain products to account for persistently low and declining rates when determining customer premiums. We've also seen management teams at the life cos do a better job managing this asset liability mismatch through the investment portfolio and through hedging activities. And we've also seen a strong focus on cost cutting and operating efficiencies to improve overall profit margins. The results of these steps is shown in the table on slide 6, which shows the estimated impact of a 50 basis point decline in interest rates on the big 4 Canadian life cos. You can see back in 2008, a 50 basis point decline in interest rates resulted in an average 2.8% decline in book value. But in 2020, the same change in interest rates only results in a 0.4% decline in book value, with the biggest improvement we've seen for Manulife and Industrial Alliance. So what does this mean for the life insurance sector? Well, slide 7 shows you how this reduction in interest rate sensitivity has really driven consistently higher returns for the sector. So here we're looking at quarterly return on equity for the Canadian life co since 2009. You can see from the period from 2009 to 2012, average return on equity was 6.5% with a standard deviation of 3.6%. And then from 2013 to 2020, when some of these improvements were put in place, average return on equity improved to 11.6% with a lower standard deviation of only 1.1%. So not only have these fundamental improvements driven higher returns, but those returns have also been more consistent and more stable. So I want to talk a little bit about some of the stimulus measures that have been put in place, because they do a pretty good job of protecting the financial sector. So obviously with the COVID-19 pandemic, we have seen unprecedented stimulus, both in terms of the size of the stimulus and the speed with which it was enacted. We've also seen stimulus on both the fiscal and monetary side, and stimulus that helps both businesses and individuals. So obviously, the central banks, both the Federal Reserve and the Bank of Canada, cut rates aggressively back in March, and both of them launched massive quantitative easing programs as well. Of course, on the fiscal side, we've seen a number of stimulus programs put in place with things like the CERB here in Canada, expanded employment insurance, things like stimulus checks in the US. But on top of this, we've also seen specific measures from regulators that help protect the banking sector. So one example is that the regulators have given banks the ability to work with borrowers to restructure payment terms without the need to set aside additional capital. We've also seen several liquidity facilities been put in place to keep the flow of credit going. And the net result of these measures is that it ensures the banks can continue to lend to businesses and individuals. And it also helps a liquidity crisis from turning into a solvency crisis. So on slide 9, let's move on to talk a little bit about valuations, starting with the banks. So here we're looking at a measure of relative valuations. We're looking at the price earnings multiple of the banks relative to their corresponding benchmark. So on the left side of the chart, you've got TSX banks currently trading around a PE multiple over the next 12 months of about 10.5 times. But importantly, this is actually a 38% discount to the TSX. And this compares to a 10-year average of only 27% discount. At the same time in the US, the S&P 500 banks trade at a PE of around 11.8 times. And this is a massive 45% discount to the S&P 500, again, versus a 10-year average of only 27%. If we look at other measures, which we're not showing here, things like price to tangible book, banks are trading near the financial crisis lows. And all of this is despite the improved fundamentals that we've discussed over the past few slides. We see a similar thing for the life cos looking at slide 10. So the life cos are also trading near decade lows and near a record discount to the TSX. So life cos trade in Canada actually a forward PE of only 7.7 times, which is a 55% discount to the TSX. And again, all of this is despite what we went through, higher and more consistent returns. So taking a step back, why do we think bank and life co valuations are so cheap? Well, ultimately, we think the sector has been left for dead a little bit over the past decade or so as investors have been attracted to more growthy sectors like technology. We do think the market is ignoring the improvement we've seen in the fundamentals, and the fact that the financial sector actually remains profitable, even in one of the worst recessions we've ever seen, suggests to us that these valuations are too low and we will see some reversion back to the mean. We think this provides what we believe is a very attractive entry point for investors with any sort of like medium to long-term investment horizon. Last thing I want to talk about on slide 11 is just a little bit about seasonality. So historically, the fall has been what we think is the best time to buy financials. So here we're looking at financials in Canada relative to performance versus the TSX. And you can see that September and October and November have historically been the best time periods where financials have delivered the strongest performance relative to the TSX. And of course, this coincides with Canadian bank year ends coming up on October 31st and reporting in late November. Before we conclude our call, I note that many of the topics we discussed today may have contained forward-looking statements. This information by its nature is subject to risks and uncertainties that may cause actual events and results to differ materially from such forward-looking statements. Further, I would like to reference today's date, October 1st, 2020, as some of our comments are time sensitive. That concludes today's call. Thank you for listening. If you have any further questions, please don't hesitate to contact our investor relations line toll free at 1-866-642-6001. Thank you.